Where's the clicker? Mine is a simple task. It's more or less to paint a picture of what happens to be a story of two halves, what happened before devaluation and what has happened after devaluation, and what's our outlook and how do we see all these dynamics playing out. I know there are a lot of questions up front. Hopefully, over the course of the next 10 minutes or so, I'll be able to address some of those concerns. So, key highlights, we're still above our service revenue guidance of at least 20%. So we're at 21.4 so far. As you could see also in terms of what Carl has amplified, in terms of our data strategy, you see our data growth going, our data revenue growing at 36.4, which is right about the right trajectory we wanted to have. FinTech, you hear from Ellie shortly and the team. And the initiatives that are putting in place, we're still growing, 5.6%. Like Carl also said earlier, voice is still growing, even in this market, so that's a good thing. And despite, or in spite of all the headwinds, we still recorded EBITDA growth of 16.3% as at 9 months. Now, we've seen a margin erosion by 2.4 percentage points. That's mainly because of the dynamics of the devaluation of the currency. As you know, we all had a massive devaluation, from 460 naira to 760 naira at the end of June, and that's about 68%. So what that does is that it affects the dollar-driven expenses that we have, and I'll unpack that in a second. So the profit before tax is down, mainly because of the unrealized gains, unrealized losses on exchange. Our capex intensity is still in line at 17%. And of course, more importantly for you investors, our free cash flows over $500 billion, $500 billion, which is a good thing. So that said, remember what's our financial framework, and this is how we bring to life Ambition 2025 in terms of how we're making our money, in terms of free cash flows. So the first pillar is the service revenue growth, the margin expansion, and the value-based capital allocation. Now, based on what we've said previously, and some of the questions I've posed to the Honorable Minister a while ago, you could see the criticality of ensuring there's the right pricing in the industry to compensate for the additional costs. So, all said, even though at the moment we're still above growth, 20%, but actually do the average inflation for year to date, it's about 23%. So, our service revenue growth of 22% is still lagging slightly behind, and that's why that discussion on tariff increases or right pricing, as the Honorable Minister put it, is important. We'll take advantage of the growing consumer voice revenue because obviously they have higher gross margins, and that will also help cushion the effect. And of course, we're going to scale our platforms. So that's the first thing. Second thing is the margin expansion. Now, we've known that with our previous guidance, we did say that every 10% devaluation in Naira would probably affect our margin by 1.3 basis points. Now, if that has gone about sixfold, that's like easily about 9 to 10 percentage points. So, in the next slides, I'm going to talk about how we're going to unpack that to, restore that margin, or, what things we could do in that place. And of course, our value-based capital allocation framework, which we've talked about severally. So that takes us to the next thing, to unpack the service revenue, what we need to do. Now, it's always a good thing that you can see that voice has declined from 66 or 67% to 47%, and data has ramped up from 24% or 25% to 42%. Now, FinTech when they ramp up, digital and all these other things all goes to that story. And of course, once we have the right pricing in the industry, in terms of optimizing our tariffs and making sure that we're getting value, then automatically that service revenue envelope is going to grow. And of course, through the share strategy, which has to do with, in terms of the handsets, affordability, and all those things that we put in there in our dual data strategy also to make sure that we're actually optimizing more from the consumer. All these things will all add to a strong and robust service revenue growth. Now, of course, once we fix the service revenue growth, at least to be in tandem or close to the inflation, automatically that will all flow through to the bottom line. So that's the first thing that we can talk in that regard. In terms of our expense profile, and that's where the elephant is in the room, in terms of why are you having all these spiraling costs, or what's happened to our cost profile? Well, it's a simple thing, it's a simple equation and nothing to be too worried about in terms of the construct and the context of that. So in terms of the OPEX, it's more like 66.5% of our total costs. As you can see, even before devaluation, even with the devaluation now as of September, it's just gone up by about 3 percentage points, over 3% in terms of the mix. Now, however, the real cost of the underlying thing driving that is really the leases, the tower rental cost. And if you look at it carefully, you will find out that the leases now accounts for about 58.8% of the total OPEX. Now, prior to that, prior to devaluation, at least it was about 55. So you've done a 3.4 movement. So if we go to the next slide, and this is about understanding our tower contracts, because oftentimes when you look at the narrative, when we release our quarterly results, you might be tempted to compare us with some other operators, but without understanding this slide, you might be making the wrong comparisons. So what's the first point? Our site splits. Now, IHS, which is our major tower provider, accounts for about 80% of our tower sites. Now, that contract itself is what you call a technology-based contract, technology-priced-based contract. So it's different from a space and power model type of contract. So what does that mean is that once you have a technology upgrade, for instance, you pay for those technologies. So as we're rolling 5G out, for instance, we would be paying more, even though it's the same site. Now, of that, ATC currently has about 2.3 or 2,300 sites of that. CAD has spoken about the 2,500 sites that are moving out at the end of 2024 to ATC, and we are firmly committed on that. We're almost 100% confident that that is going to take place, no issues in terms of migration. So that's clearly out. And one of the reasons why we did that was that when you look at the technology-based pricing contract that we have, it's actually expensive. Same infrastructure, you pay more for adding new technology. So we try to go through a process, procurement process, where we put out those sites on tender to get the best pricing. And one of the things we achieved with that was to actually remove technology pricing from that construct of sites. So going forward, you will see those savings coming out in the future. Now, despite moving those sites end of 2024 to the new service provider, IHS will still account for at least over 66% of the portfolio. So we still have this technology pricing issue thing to do. And of course, the majority of the sites are going to expire in 2029. Now, here's the thing you need to note. Why is it that the impact of devaluation is much more on an MTN, as an example, than other operator? It's a very simple matter. Now, when IFRS 16 was implemented in 2019, the standards actually provides that you should separate your lease costs between your rental cost between a lease component and a non-lease component. So basically, you are going to evaluate the portfolio based on what your service provider is giving you, and then you are going to split that cost into a lease component and a non-lease component. Now, at the time we implemented that, it was deemed that the lease component of our lease rentals at the time was 47% compared to the non-lease component. Now, which was 53%. So what that just means is that 53% of that cost is going to be expensed at your EBITDA level. And the balance, the lease component, is what you're going to calculate your, what they call a right of use asset, and you create a liability on your financial statements. So depending on what other operators did in that split, it will impact on, or to have an effect on how it impacts your EBITDA. In our own case, it's like I said, 57%. Now, for newer sites, or build-to-suit sites, or 4G, 5G upgrades, the split is actually even higher. In other words, the lease component of the 4G or 5G upgrade is at 34%, compared to the non-lease at 66%. So, in a nutshell, when you now look at the income statement, you're going to see that with the valuation and the rising cost of funds, because you have to impute a finance cost on the non-lease aspect, your cost will spiral. So that is why the proper way to look at it is that whether you're, regardless of whatever the split is, the impact on the bottom line is going to be the same. Just that you always have to make sure that don't focus on the EBITDA all the time. You actually have to look at what's also happening on the amortization of those leases, which is below EBITDA. And you have to add those two to find out the impact when you're comparing MTN numbers with any other operator. So foreign exchange, I'll take that as read. We've all said these things before. There are energy pass-through contracts, which just means that for the ATCs, we pay a differential between the base rate of the diesel to them, whereas for the IHS, it's all-inclusive contract, and there's the CPI escalations. So in terms of our strong margin EBITDA evolution, this is the picture of what it is. We see that we are currently at 51.2 in spite of the headwinds, and ahead of what we see in Q4. Carl has just talked about the tax tribunal, so we are obliged to fully provide for that in Q4. As at year-to-date September, if you were to have done that provision, that's probably roughly about 1.6 percentage points on the EBITDA. Obviously, by the time you have a full year EBITDA and you're applying that provision on it, probably it will end up at 1.2, 1.1. So that's one of the things. The tax on leases, I'm glad Taiwo is still in the house. It's an additional burden because we are not able to pass that on to anybody, whereas it should be passed on to the consumer. So basically, we incur that as another additional burden, and that took place after the expiration of the presidential executive order that granted a 3-month stay of the Finance Act. So, with all these things, in terms of what we see in Q4, we did give our guidance that during the investor call that we were saying about 47 to 49%. It's probably going to be at the higher end of the scale of that margin, to be honest, based on what we see at the moment. But of course, no Q4 numbers have been released, so I can't tell you more than that. But that's just the construct on what we need to do. So one of the things that we can do, that we're doing, we have our expense efficiency program, and this program is designed to optimize or to increase the margins. We started off with a target of 95 we started off with a target, and we were actually realized 95 billion of those efficiencies, up 36% ahead of our target. So which means we're always continually looking for areas where we're going to increase or optimize our costs and savings. And on the slide, which will be distributed in due course, you'll see the areas where those savings came from. So even in spite of the strong headwinds, we actually added 8.1 billion in the 9 months to date. In terms of the impact of forex liberalization, the major thing there is the forex impact, but the key thing there is it's an unrealized loss on exchange. Now, if you are to normalize it, you will see that the business is tending in the right direction, notwithstanding all the headwinds that we're facing. So, what do we need to do? We continue to go to explore the mix of our local contracts to make sure that we have the right pricing to get the best out of it. In terms of our capital allocation, we are going to continue to optimize how we generate or roll out our capex. So, which is what this slide is talking to in terms of how do you maintain your capex envelope or capex guidance without to support the massive growth opportunities that are exist out there. So what we're trying to do is that we're looking at different ways. One of the ways we do that is through our disciplined capital expenditure framework. As you can see, we've rolled out from 4G coverage from 60% to 80%. 5G is now at 7.5%, and that's all within our target of maintaining 18%. So one of the things you should know is that there's always opportunity for data growth. And one of the things we have to focus on how best can we optimize our capex, doing more with less. And one of the things that we've done is to use spectrum as a means of delivering that capacity. So once you acquire new spectrum, like we did, or lease spectrum as the case would be, from MTN, and acquired the 2.6 spectrum from Open Skies, what you see is that you've been able to grow or carry more traffic on your network at probably a third of the cost it would have cost you if we had to build new sites to carry that traffic. So clearly, spectrum efficiency is the optimization is the way to go, and that way we've been able to avoid up to over 269 billion, I think it was, or thereabouts, in terms of what it has cost us to build new sites. So we remain disciplined on our capital structure. Our covenants are all intact. There's no risk of breach. We have healthy headrooms. In terms of our borrowings, still about 60-40, 60 being local, and it's only 60% because of the devaluation of the foreign loans in that space. We're AAA rated, one of few companies in the market that's AAA rated. We continue to raise instruments in the market in short term below the sovereign, and that's also attests to the strength of our balance sheet. And more importantly is the fact that 51% of our loans are actually fixed, and they are fixed on a 7 to 10-year bonds at 12 to 13%. Now compare that to where inflation is. So it just tells you that in terms of the financial health of the balance sheet, we're in a good space. I'll take this. I won't necessarily okay, I need to dwell on a point on dividends. It's one of the questions that may come. So dividends is a function of the results for the year. We have a dividend policy clearly that says that we'll pay up to 80% of the retained earnings. So whatever that number is at the end of the year, that's what it's going to translate to. However, what is clear is that there has been a devaluation which has impacted on the unrealized losses on exchange, which also is going to affect your PAT, and that would affect whatever or impact whatever decisions will be made. So, key takeaways. Good news is that we have a well-developed framework that supports our growth and ambition 2025 strategy. As management, we are upbeat. We've been here before. The headwinds notwithstanding, it's just business as usual as long as, and you can easily see that through the strong top line, robust growth that we have experienced, notwithstanding the headwinds. We won't focus on our expense efficiencies. We've done 8.1 billion year to date, and our hope is that we'll continue to look for other areas that will optimize, that will give us. We have a strong balance sheet, there's no doubt about that. with sufficient headroom to withstand the macro volatilities. Despite the exchange losses, you could still see we still have reserves, and we still have positive reserves, and we actually still recorded a profit after tax. And of course, we would continue focusing on our commercial strategy, which Hassan would also unpack in the next session with Eddie. And we're going to drive operating leverage to support growth in earnings, cash flow, and returns. So, in a nutshell, from our point of view, the future is right. We still believe strongly in the Nigerian investment case. Once you understand the dynamics of our tower contracts, focus on the bottom line, because everybody is going to have those issues, regardless of the splits between leases and non-leases. And with that, I would wrap up, and thanks for your kind attention.